Hi, everybody. Welcome to our broadcast on the CARES Act. I'm going to ask everyone a favor. If you can hear us, can you just raise your hand as an attendee? I want to make sure everyone is able to hear us clearly. I haven't seen anybody raise a hand yet that they can hear us. Perfect. Looks like we have some people coming through that can hear us. Great. There we go. Awesome. Well, thank you everyone for attending today. Tony and I wanted to go through the CARES Act and just how it impacted student loans and what has come out in the past few weeks. There's been a lot of news around the CARES Act in a whole, mostly around the relief checks that maybe some of you have received probably yesterday or today. They are starting to come out from the IRS, but we wanted to take some time today to touch on what that is impacted by student loans. If you have questions while we're going through this, there should be a section where you can ask questions. So if there's anything you want us to go over that we aren't talking through, just feel free to shoot a question. We'll make sure to address it at the end. For those of you that don't know us or haven't worked with us before, here is the team. My name is Ian Klinger, and then we also have Anthony Corio on the line. So I believe, looking at the attendees list, have worked with most of you in the past. Some of you may be new to us, but this is an overview of just our team. Briefly, I wanted to take a moment to just set the stage of what has been going on and kind of how we have got to this point. So obviously, everyone is aware of the severe economic impact caused by the COVID-19 pandemic. What has happened, like I said, in the past 2 weeks is the federal government has put into place its largest stimulus package that has ever been put out in our country. In total, it was over $2 trillion that were put out. Now, a lot of this is being put out in other areas. You may be familiar with the paycheck plan that has been talked to for small businesses. I mentioned the relief checks that have been out there as well. But also in this package has the piece related to student loans, which we will mainly just address today. So if we look back and how this all kind of occurred, on March 13th, President Trump declared on national news that he was going to provide student loan relief. He may have did that a little bit prematurely, but the Department of Education was able to back him and put out a notice that the relief would be put out for 60 days. So it would be a period from March 13th, 60 days after that would provide student loan relief. After that, we look forward to the CARES Act, which was passed on the 27th, on March 27th. As I mentioned, it was the massive stimulus bill. This really solidified what President Trump had said, and it went on to expand what was announced on the 13th of the 60 days, and it now pushed things out for 6 months. So we're now looking at a timeline of September 30th when everything is pushed out to. One thing to keep in mind, the relief is only available to borrowers with outstanding federal loans. So this is not impacting on your private loans. If you do have private loans, what we would recommend is talking to your loan servicer and who holds those private loans to see if they're offering any relief. A lot of companies right now are providing relief if you are affected by the COVID-19 and your income is changing. So I would just recommend talking to them. Everything we talk through today will be in relation to federal loans. So what is the relief being offered? So we have two separate pieces of the relief. The first being that all interest is waived starting from March 13th until September 30th. So all loans are being moved up to a 0% interest at that time. One key piece to note that any payments made during this time, should you elect to make payments, will be applied directly to your accrued interest first. It will not touch your principal until any accrued interest is paid off. So that is one thing to note. The second piece of relief that is being offered is a suspension of all payments. So what that means is until March 30th, you are not required to make any student loan payments. A lot of people have received, I believe, last week letters from whoever their loan service provider is, contacted them regarding either a stoppage of payments. Our advice in this area is to just monitor whoever services your loan. Some have elected to continue auto payments. Some have completely turned them off. I would contact them if you want to turn off your auto payments or log into your website to do that, and just be sure to monitor them over the coming months. So that is basically the general gist of what is being offered. The piece we wanted to touch on today is what are some of the planning opportunities that come with this new relief, with interest being waived and a suspension of payments. So I'll turn it over to Tony to go through some of the planning topics and ideas that we want to discuss with everyone.
Thanks, Ian. And as Ian said, this is definitely want to keep it interactive from a question and answer standpoint. So there is a spot to type in questions. So if you have questions, please type them in to the place provided. We're happy to address those as we go along here. So a couple of things in terms of planning topics, right? This is really where I think we can provide the most valuable to you guys and to our clients. You know, there's a lot that you've heard or read, and Ian just went over a lot of the bullet points about what the program is offering. The question now is, what's best for me? What should I do? How can I take advantage of this opportunity? So one thing that a lot of our clients ask about and are planning their loan strategy around is public service loan forgiveness. If you're not familiar, public service loan forgiveness is 120 payments made under an income-driven plan or a combination of an income-driven plan and a 10-year standard plan. If you are working for a nonprofit, will go towards forgiving your loans after 120 payments are made. So the big question going into this was, if I skip these payments, so the government's giving me the option to go in forbearance, 0% for 6 months, but I want to get to that 120 payments as soon as possible. So should I make a payment? Well, the good news is you don't have to, and the payments will still count towards that PSLF, or Public Service Loan Forgiveness Plan. So that's a big advantage for those who are looking to do that. You don't have to make a payment in order for those to count. So that shouldn't affect your strategy, which is good news. It's a way to count those payments without making them, which is always a good thing. If you did make a payment after March 13th, there was still a lot of details being hashed out in the early stages. A lot of loan servicers still drafted those payments. You can apply to get that money back. So let's say your payment's $600. It drafted, auto draft on March 20th. You could get that payment refunded to you. Now, it may take a couple weeks. Some are saying 4 to 6 weeks in order to get that money back to your account, but you can get it back. So the question then becomes, should you make the payments or should you not? So we'll get into that on the next slide. But a couple other points here to think about too. If you are at a position where you are losing income, whether it be you are laid off, furloughed, just working less shifts or incentive, there's some opportunity there as well if you are on an income-driven plan like IBR, like Pay As You Earn, or Revised Pay As You Earn, where you can actually recertify your income at any time if you're experiencing a reduction and lower your payment. So if you are trying to have the lowest possible payment, maybe you're trying for public service loan forgiveness, and you do have an event here with this pandemic that lowers your income, you can recertify that income, which will lower the monthly payment that you have for the next year towards that loan. So that's a good opportunity there to think about, and certainly contact us if you have more questions about that. If you're not enrolled in an income driven repayment. So if you're in forbearance or something like that, you should definitely sign up for a plan so that it starts to count towards that opportunity. It's definitely something that you might as well sign up for one of those plans if you're going to be in forbearance anyway. That way, those payments will start to count and you'll get the 0%. If you're at a position where you're graduating, college, medical school, dental school, generally speaking, after your school, so if I graduate medical school, I have a 6 months grace period when I start my residency before I have to start making payments. You should opt out of that. During that time, those payments don't count towards the public service loan forgiveness. So if you opt out of that and start paying right after you graduate, you still won't have payments for 6 months under this plan, but they will start to count towards the 120 payments that you'll need for public service loan forgiveness. So it's something you definitely want to think about if you're somebody who's approaching graduation. And the big thing, have a plan for repayment after this 6 month period is over. So this won't last forever, unfortunately, and you never know, it could get extended even beyond this 6 month period, but you want to have a plan for when it happens. I did hear recently that they were in this plan are sending out like 6 different reminders to you that your payments will be starting again. So unless you're not getting those emails or mailings, there's no excuse not to be prepared when that happens, which should be sometime around October, November. But just have a plan. This is something we help people do all the time, create a strategy for the loans, how to pay them off, what opportunities are available to you. Certainly a great opportunity now that everybody should be taking advantage of. But eventually, you're going to have to go back to paying them. So figuring out what is the right opportunity at that time is also crucial. So speaking of opportunities, let's talk about some, right? Because you don't have to make a payment doesn't mean you can't make a payment, right? So we've had a lot of people ask us if they should, or some people just said, well, I'm just going to continue because I'm already used to that cash flow leaving. So it's certainly a different answer to everybody, but where should I allocate that money? So a couple of things you want to look at are what other opportunities would you have for that money? So if my payment is let's just say my payment is $1,000 a month. So that's $6,000 over the 6 month forbearance period that I could use for something else, or I could apply that to my loans, to the loan interest. A couple of things to factor in. Number one, are you going towards the public service loan forgiveness? If that is a goal of yours and that is in the strategy that you currently have, then I would definitely not make any payments during these 6 months. If public service loan forgiveness, if you want the loan to be forgiven, which is tax-free, then you want to make the smallest amount payments possible during the 120 payment period. So you want to pay the least amount back and get the most amount forgiven. So you would not want to make any payments during that time. What I would suggest, assuming you don't have a loss in income, which is a big assumption. A lot of people are having reductions in income. So that's a whole nother story. But if your income isn't affected, take that payment, let's in this case $1,000 a month, and make sure you do something productive with it. So what to do with it? There's a lot of options. First thing I would look at, first and foremost, is what does your basic savings look like right now? What's your emergency fund like? How much cash do you have liquid if you needed some money tomorrow? That should always be the first thing that you consider. We want to see that it varies in terms of size. A lot of experts will say 3 to 6 months of expenses is a good amount to keep in liquid savings. Some people will go further out to say 6 to even a year's worth of expenses. That number we can kind of work out together, but you definitely want to have some sort of cushion. So if you're living paycheck to paycheck, there's not a lot of money in your savings in case of emergency. First and foremost, I would go right there. I would put that money into a savings account. Do that over the next 6 months. Make sure you save that money. If you did have a loss of job or a reduction in hours or salary, it's a good opportunity to use that cash flow to pay your bills. Obviously, you'd love to have an opportunity to invest it, but we get it. I mean, life happens, and if you need that money to pay your bills, that's what it's there for, in order to free up some relief. So actually use it as relief if you need to. Let's say you don't have a reduction in income, you have enough money in savings. What else can you do for that? So if you're not going for loan forgiveness, which is probably a good bulk of people, you could put it towards the loans. You could say, I'm going to take that money, that $1,000, I'm going to apply it to the loans at a 0% rate. So it's a good way to attack those loans. I would say it depends on what your overall strategy is with your loans and your thoughts about debt. If you are somebody who is trying to pay off that debt as soon as possible, take the money and continue to pay it. Pay it towards your loans. If you are somebody who wants to explore other opportunities and your plan is not necessarily to pay off the debt as soon as possible, but maybe a more macro financial plan to build up your investments and savings and things like that, and it's a great time to start to invest or even increase the investments that you're already doing. So that's a question we've been getting a lot because of the stock market. All right, so right now, the stock market is very volatile, right? So over the last probably 2 months, we've seen a big decrease in value in the market. That has bounced back a little bit, but it's still a lot lower than what it was to start the year and early on in the year. So that's why you're hearing it's a great opportunity to invest. It really is. A couple of things with that. Even though it's a great opportunity to invest now, we don't want you to invest for the next 3 months, 6 months. We want you to only invest if it's more of a middle to long-term strategy. This is not a time to look at get rich quick. It's a time to say, now's a great time. I should start investing money. I don't need this money in the next, let's say, 2 years or so. What can I do to grow the money? All right, because even though the market is down for the year overall, doesn't mean it can't continue to go down. All right, so there's still a lot of uncertainty with the economy with this virus. That's going to play a factor in stock prices. There's different factors that go into the pricing of stocks. One of them is more numerical factors like earnings. We haven't really seen a big drop in earnings reported just yet. We're starting to, but you're not really going to see that. That's going to lag all of the social distancing. People aren't going to report those lower earnings till a little bit later, that's where you might see some panic with investors when those numbers are actually reported. Other factors into stock prices are things like news, right? So how this virus changes things, how people foresee the future and spending and their job security, those are all factors that will change stock prices, how investors are feeling. So if we find out that they continue to push back the social distancing guidelines, which a lot of states did just this week. I know New York yesterday did, I think, till May 15th. That could continue to delay the recovery from an economic standpoint. I know we have a lot of healthcare professionals on the call today. Thank you so much for what you guys do. And I'm sure you are saying, the same thing that Dr. Fauci and some of the other people are saying is we gotta flatten the curve. You have to stay in. The economy has to come second to public health. So if that continues to go on, we don't know exactly when that'll bounce back. So just know that even though it might be a good time to invest, and you may have heard that, let's say you have a stock that started the year at $100 per share, is now trading at $70 per share. That's a discount, right? That's like a 30% sale at your favorite department store, right? Something you've been meaning to buy for a while. It's been $100. All of a sudden, you see a sale, a Memorial Day sale, it's $70. It's a great time to buy, right? That doesn't mean that you buy it at 70 and 6 months from now, it's trading at 50. We have no idea. So we're not investing for the next 6 months. We're not trying to double our money quickly. We're not trying to get rich quick. We still have to keep in mind our philosophy around investing, and that is a long-term one. So there could be opportunities where stocks rise very quickly, but we don't want to bank on that. We want to still continue to keep our values and our thoughts in terms of investing, which is more of a long-term outlook. Regardless, though, if it does, if you took an advantage and said, I'm going to put money in at 70, 6 months later, it's trading at 50, you were bummed out, don't be. You still, in my opinion, made a good move there. You still got it at a 30% discount. It just happens to be at a 50% discount now, but you can't kick yourself. Eventually, if the stock is actually worth what it says, it's going to go back up. We just don't know when. We don't know when the bottom will be. Some have said that the bottom has already happened. Some will say that it hasn't. There's no way that we know. There's no way we're going to try to predict it or guess. We want to make sure that we have a prudent investing strategy and continue to invest. What I would say is it's a great opportunity. If you have 6 months of some cash flow freeing up, it's a great opportunity to start to investing on a regular basis. So money going in every single month. That is going to separate the good investors from the great investors long term, or savers, is how much you allocate and how often you allocate money into your portfolio, not necessarily the rate of return that you get. So if you have cash freeing up now for the next 6 months, it's a great time to start to invest in the market on a regular basis. If you're not ready to invest in the market, it's a great time to put money in a savings account on a regular basis. Start to build those habits. Don't look back 6 months from now, again, assuming you don't have a big loss in income, and say, I didn't do anything with that opportunity. I had 6 months where I didn't have to make payments, and I don't know where that money went. Where that $6,000 went. The chances are you're not spending a lot right now as well. We're not going out to eat. We're not doing a lot. We're not going out to Target because we're bored and spending $300 before you know it. So it's a good time to bulk up those savings if you are fortunate enough to be somebody whose income has not suffered from this. It's a great time to do that. So just looking at some opportunities there, it is a great time to invest, but keep in mind that we don't know what the volatility is going to be like over the next month, 3 months, 6 months, even year. We could continue to see some downward movement in the market. It's just an unknown factor. We don't know when everything's going to turn. Certainly our president wants it to just bounce back like nothing happened pretty quickly. Is that feasible? Who knows? I really don't know. Probably not. It's probably going to take some time. Different areas of the market are going to be impacted differently as well, too. Different sectors. Some companies, it's going to take a long time to bounce back. Some are going to see this as an opportunity. Some already have, right? Obviously, some of the more notable ones that are easy to see, you have a company like Clorox or Zoom telemeetings. It's an opportunity. But at this point, they've seen some good growth. I would look at some companies that have that potential growth in the future. Even better, diversify what you're doing. Buy a fund that invests in a lot of different asset classes, a lot of sectors of the market. Own as much of the market as possible and let the market do its job. But regardless, you don't want the opportunity to pass you by. You don't want to look back and say, I didn't do anything with this opportunity. It's a great opportunity that the government's providing here. It could continue to go. It is not a time you want to look at refinancing your loans. Do not refinance any federal loans right now. Hopefully that goes without saying, but it would not be 0% at any bank. If you have private loans, you may still want to look. I don't know how this has impacted them too much because a lot of people aren't looking to do that right now, but private loans, you're not getting this opportunity. They may provide some opportunity for those who've lost their jobs or things like that. That's worth checking in with your lender about. But otherwise, if you have federal debt, not the time to go searching for a private refinance or consolidation option. Just some reminders about your student loan repayment options. This is more of just a review. You have income-based, income contingent. Most people now, though, are on these two here, the revised pay-as-you-earn or repay, or the pay-as-you-earn option here. We can certainly help you choose which one is best, but that's what we're seeing most often. This is just kind of a recap of that. So certainly reach out to us if you have questions about which payment option you should be in, how taxes and how you file your taxes affects that. We're certainly happy to discuss those things and make sure that you're confident in the loan option that you pick. So that's most all we have. Let's look at the questions here that we have. Federal loan consolidation is one of the questions that we received. At this time, you don't want to consolidate the federal loans either. The best time to do that, and I will say if you are graduating college or med school or dental school or any type of graduate school and you're just now starting repayment, that's when you may want to look at consolidation. Other than that, I would just hold off on looking at that because right now, again, you have 0% with the loans that you do have. There's really no benefit to consolidating. Remember, if you are trying for public service loan forgiveness, if you were to consolidate your federal loans, any payments that you made before that time would not count. Basically, it would restart that process of the 120 payments. So always be aware of that if you are trying for the PSLF. We've had some unfortunate times where we've met people and they did not know that and they consolidated loans and it erased a lot of those payments that they made. So with the exception of somebody who's graduating right now, probably not the best time to look at federal loan consolidation at this point. Any other questions that we have? In terms of content, that's basically all we had. We didn't want to put an hour of content. We wanted to make sure it was kind of short and to the point, but also answer all the questions that you have. If you have specific questions to your situation, we're happy to answer those. You see our emails on the screen there. A lot of you already know us. We're happy to reach out. We're happy to answer more specific questions that may pertain just to your situation. If you want help developing a strategy behind this, learning about where to invest, should you continue to pay them, what other options you have, that's something we do all the time. We have a lot of knowledge about, we're very passionate about helping in those areas, so certainly reach out to us for those considerations.
Hey Tony, we just had another question come in. You want me to read it to you?
Yeah, go ahead.
So the question is, if you have accrued interest, does it make sense to take a chunk of your savings and just pay it off now so future payments actually touch the principal? Or does it make sense to try to invest that money / keep it in savings?
Yeah, it's a great question. The answer kind of is it depends. There's different ways to look at it. I'm just going to assume we're not talking about public service loan forgiveness because I already addressed that. But it just in general, one depends on what your actual interest rate is. If you're somewhere between 6 and 8 or higher, might not be a bad idea. Depends how much loan interest you actually have. If you have a couple $1,000s of accrued interest, it's going to make a bigger impact to put it towards that versus if I have $60,000, $70,000, $80,000 of accrued interest, it may just be a little drop in the bucket and you might not really see much of an impact there. So it might, in that sense, be more impactful to invest that money, start to grow that money, and then be able to pay it off in chunks in the future. I don't think it's ever a bad idea to take money, cash flow, let's say, and allocate it towards investments as opposed to loans. And the reason being is it gives you the advantage of taking advantage of a lot more opportunities in the future, right? If we use right now as an example, so let's say I spent the last 5 years putting every last extra dime I had towards my loan payment. I kind of disregarded savings and investing. And now we get here, and maybe my job is in jeopardy, or I took a 50% pay cut, versus somebody else who did not put a ton extra towards the loans. They maybe did a more extended strategy of paying off those loans. But they took the money that they could be putting towards the loans and they did invest and they did build up their assets, their savings, their liquid money, their investments. Fast forward, same scenario 5 years later, they lose their job or take a 50% pay cut. Who's going to be more comfortable at that time? The person who has a lower loan balance but next to nothing in the bank, or the person who still has a higher loan balance, still making payments on those loans, but has a nice cushion of savings that they can withstand something like this that they didn't see coming, where they lost 50% of their income. So it just puts you in a position to help against scenarios like now. Could be the opposite. Could be something good that comes around in 5 years, which maybe it's an investment opportunity, an opportunity to buy a business or buy real estate. We talk about that a lot. If you don't have cash on your balance sheet, you may not be able to take advantage of those opportunities. So even though you did a great job paying down your loans, it doesn't give you a cushion to take advantage of opportunities that somebody else may have. So I favor going towards the investments, unless you're at a point where you can kind of see some light at the end of the tunnel. Paying down the accrued interest will get you to a point where you're knocking down principal. That might help. It might help psychologically. It might help financially as well too. So there's no right or wrong answer. Definitely do one of those things as opposed to not doing either and end up spending the money. My thought is probably invest, but again, it depends on situation. It depends on your feeling towards the money or towards the debt. If you're somebody who that's the sole goal since you graduated was to pay that down as quick as possible, then by all means take advantage of it, pay it down as quick as possible. Otherwise, I would lean towards investing. Any other questions, Ian? Or do you have it?
Looks like, no, I think that was great. That looks like all the questions that came through. If anyone has anything else, feel free to shoot us an email. As Tony mentioned, we'd be happy to go over your specific individual situation and have a conversation with you around that. But I think, as Tony mentioned, that's all we had. Wanted to keep it short and sweet for everybody. So thanks, everyone, for joining the call today. We look forward to chatting with you in the future.
Look out. If you don't follow us on social media, on Facebook or LinkedIn, definitely do that. We'll be posting articles, we'll be posting blogs, we'll be posting short videos and webinar opportunities like this to keep you guys informed, to answer your questions, to talk about changes the government's making. I wouldn't be surprised if there are more changes with student loans. We don't know for sure, but we'll see. But definitely keep your ears open. Just by being on the call today, I think it's a good thing that you're looking at opportunity here. So let us know how we can help in all areas of your financial life, as well as the student loans and opportunities available there.
Great.
So we'll wrap it up. Thank you for attending today. Hopefully you all got some value out of this, and we hope to hear from you all soon.